It's been a summer of bleak economic news, but Federal Reserve Chairman Ben Bernanke's hints for a potential third round of bond buying have helped buoy markets in recent weeks. Here to weigh in on where the market is headed next and where to invest now is Stephen Hammers, co-founder and chief investment officer of Compass EMP Funds. Steve, welcome to the program.
Thank you. I appreciate that. Thank you.
Steve, are you bullish or bearish on U.S. stocks now?
Well, I am slightly bearish on U.S. stocks. I haven't been bullish in probably a year and a half now because there are very bleak outlook for the markets around the world.
So what would cause you to become bullish? What are you watching now?
Well, I would say we'd have to have a miracle. I'd really be looking for improvement in spending and improvement in debt around the world, because right now it's creating a tremendous amount of uncertainty around the world. Just do not see it happening. It's not about profits. It's all about concern and the debt crisis around the world.
Building on that, what's your outlook for Europe? Are there opportunities in European equities? In essence, has the baby been thrown out with the bathwater?
There are opportunities. We do have the CAMP International Hedge Index that we have published that we're at 50% cash, 50% long. We do limit the exposure to Japan, thankfully. But, you know, the outlook, most likely we're going to have a down year in Europe, somewhere between a -5 and a -15%, most likely in Europe. And the U.S. will probably be flat to very.
I have in my notes here that you are actually long most bond markets around the world, notably U.S. Treasuries and German bonds. But how much lower can yields go from here? These safe havens seem to be pretty pricey to me.
It's very, very pricey, and we're actually in dangerous territory. You know, we have an all-time low. Treasury yields today are down to about 1.43. That is unheard of. As we start sliding down towards 1.4, our outlook for this year was 1.5. And what that really means is we're in very, very dangerous territory. And if investors have bond funds going out over the next few years, they could see significant declines because yields are only going to go up for two reasons. One is we have economic improvement, which most likely isn't going to happen anytime soon, and two, our debt gets out of hand. So we are in very dangerous territory, we feel, within the bond market.
Okay. Switching gears for a moment to commodities, what is your outlook for corn prices and soybean prices, given the tremendous drought that has really swept over half of the continental U.S.?
We do not expect many of the agricultural commodities to go up considerably like they had been, because most of the issues of the drought are calming down now. So no, we do not consider them going up considerably here. And those are the few commodities that we are long. Most other commodities we are short due to the outlook of the slowing economy.
Like what? Gold is obviously seeing a bit of a downdrift here. Crude, until recently, was also moving lower until we saw some of the events in the Middle East come back to the table. What specifically are you short in the commodity space?
Well, the question is, what are we not short? We focus on the 20 most liquid commodities. We are now about short 14 of those commodities. We just went long natural gas, but most of all of your industrial metals and your precious metals, we are short, like gold, copper, silver, those sorts of things. Other assets that we're short are gasoline, heating oil, crude oil, cocoa, zinc, cotton, sugar, cattle, those sorts of assets. And it's paid off considerably in the last 12 months, especially in the last week.
Yeah, it's been a smart play. If I could ask you why you are long natural gas, is that merely a trade here, or do you see a more fundamental change for natural gas?
We actually have been short natural gas for about 2.5 years. And just last week, we went long natural gas because natural gas, as we all know, has declined considerably. So if you look at down its lows, about $2.30, we actually went short around $2.93. When you go from $2.30 to $3, that's actually a significant increase. And what we see is a slight trend upward going forward because of the prices that have been so depressed in the last couple of years. And it's all about where the price is going and where the trend is going.
All right, good discussion. Thanks so much, Steve, for coming on and sharing your insight. We hope to see you soon.
Thank you. Have a great day.